Ford just flipped the auto industry, and the entire US market is now spiraling into a meltdown that nobody saw coming. And it's not just talk, it's backed by real-world offers and seismic news. Right now, Ford is dangling eye-popping incentives. You can lease a 2025 Mustang Mach-E for as low as $219 a month, 24 months for $499 due at signing in some regions. The F-150 Lightning isn't immune. There's a 36-month lease for $279 a month with $629 due, plus thousands in lease cash. And if you buy or lease, Ford's Power Promise is still alive, giving you a free home charger and standard installation through 2025. On the news front, Ford just reversed a bold strategy. After the federal $7,500 EV tax credit expired on September 30, 2025, it scrapped a plan to keep that credit alive via its financing arm. Instead, it's ending that program while continuing to offer steep lease discounts. And to add fuel to the fire, Ford announced a $2 billion overhaul of its Kentucky plant to churn out affordable EVs on a new, more efficient platform, including a mid-size electric pickup that could start around $30,000. Ford's strategic shift starts with this huge price restructuring across key models that had been lagging behind forecasts. Instead of gradually adjusting like every other automaker, Ford dropped the hammer instantly, slashing prices on select EVs and hybrid trims while simultaneously rolling out aggressive incentives that analysts say shouldn't even be financially possible. Lease rates have been cut. Interest rates on certain retail financing deals were reduced below what banks are offering. And Ford even launched limited-time loyalty credits so steep they're effectively rewriting how much profit dealers can make. And just when the industry thought that was the end of it, Ford unveiled its new accelerated production plan for hybrid models, signaling that the company is abandoning slow EV rollout strategies and going all in on what American drivers actually want right now: power, range, and affordability without the headaches that early EV adopters have been complaining about all year. This sudden surge in hybrid production isn't just a manufacturing decision. It's a direct response to the chaos unfolding across US dealerships. For months, automakers have been trying to predict what Americans actually want: fully electric, hybrid, plug-in, or traditional gas. Ford just eliminated the guesswork by tracking real-time demand spikes and moving faster than anyone else. While competitors spent months in committee meetings debating production targets, Ford quietly retooled lines, shifted battery sourcing priorities, and secured new supplier contracts that now give them the ability to flood the market with the exact powertrains buyers are chasing. This is why analysts are calling Ford's move the most aggressive pivot of the decade. It's not just about vehicles, it's about outmaneuvering the entire system by reading consumer behavior with near-military precision. Meanwhile, in the financial markets, the impact is growing by the hour. Shares of rival automakers are fluctuating wildly as investors digest the scale of Ford's repositioning. Ford's price cuts and the new wave of incentives are putting enormous pressure on margins across the industry. And now, analysts are warning that some automakers may be forced into their own incentives war just to avoid losing market share at catastrophic speed. But here's the catch. Most brands cannot afford it. They don't have the liquidity, the inventory structure, or the supplier strength to match Ford's sudden discount offensive. That means Ford is effectively squeezing the market from the top and bottom, capturing budget buyers with lower prices while pulling in premium buyers with upgraded tech, easier financing, and faster availability. This is the formula that triggers a full-scale market meltdown because every competitor is being forced to play a game Ford started, but they don't have the pieces to keep up. At the dealership level, tension is turning into desperation and opportunity at the same time. Ford stores are scrambling to keep up with demand spikes as customers flood showrooms looking for discounted Mach-E units, freshly incentivized F-150 Lightnings, and the hybrid models that just received accelerated production. Sales managers from GM, Toyota, and Nissan dealers are reporting a noticeable drop in foot traffic as shoppers shift their attention toward Ford's aggressive offers. Used car lots are bracing for an avalanche of trade-ins as buyers try to offload older models before prices dip any further. This environment is creating a rare moment where buyers feel urgency, dealers feel pressure, and competitors feel panic. All because Ford pulled the trigger on a market strategy that undercuts every previously accepted rule. And the pressure keeps building as insiders leak details about Ford's next phase. Reports suggest Ford is preparing a surprise announcement that targets the pickup segment with a model refresh that accelerates the transition to hybrid powertrains while reducing production costs by nearly 18%. If those numbers hold, Ford could lower prices again before the next quarter, forcing every other truck manufacturer into a defensive position. That would especially hit GM and Ram, who are already battling inventory imbalances and slowing demand in the higher-priced trims. And that is why the next chapter of Ford's strategy is shaping up to be even more disruptive than what we've seen so far, because the real shockwave is coming from Ford's internal restructuring that hasn't fully hit the public yet. Behind closed doors, Ford has been rewriting its entire production blueprint to prioritize fast-build platforms that cut manufacturing time, reduce material waste, and allow for rapid model updates without shutting down plants for months. Industry insiders say Ford's new modular approach could let them roll out mid-cycle refreshes at nearly double the speed of what competitors can manage. That means more updates, more new features, more tech improvements, and fewer outdated models sitting on lots. This advantage becomes lethal in a market meltdown because consumers gravitate toward whatever feels newest, fastest, and most future-proof. And Ford is positioning itself to be the only automaker capable of delivering that pace in 2026 and beyond. Suppliers are already feeling the tremors from this shift. Battery partners, electronics manufacturers, and hybrid component suppliers are accelerating their timelines after Ford quietly renegotiated contracts and secured priority sourcing for the next 18 months. Rival automakers are now stuck waiting for components that Ford locked down months in advance, creating a bottleneck in the supply chain that delays upcoming models from GM, Hyundai, and Volkswagen. This is where the meltdown becomes unavoidable, because when one automaker gains supply dominance, every delay for competitors becomes a market loss, and every market loss becomes a customer shift that multiplies over time. It's a domino effect that Ford engineered with precision, and now the pieces are falling exactly as planned. Consumers, on the other hand, are realizing the power has suddenly shifted in their favor. People who had paused their car buying plans due to high interest rates are now rushing back in because Ford's aggressive financing and lease offers are effectively rewriting affordability. Social media is exploding with people posting screenshots of deals they found, dealers reporting unexpected inventory arrivals, and buyers who are saying they never expected truck or EV prices to drop this quickly. This kind of viral momentum adds fuel to the fire because it pushes undecided buyers off the fence, creating a run on Ford models at a time when competitors are struggling with either too much inventory or models priced too high to move. The market is acting like a pressure cooker, and Ford is tightening the lid with every announcement. Meanwhile, Ford's technology division is quietly rolling out updates that could shake the software side of the industry even further. Their latest over-the-air performance boost for EVs, their expanded Blue Cruise subscription flexibility, and their reworked charging integration with more networks are being positioned as a major selling point for new buyers. Competitors who banked on software subscriptions for long-term profits are now realizing Ford's more customer-friendly approach may force them to rethink their models entirely. A pricing war on software could be next, and that would create another layer of chaos for an already unstable US auto market. And all of this leads into the next massive turning point. The moment that analysts believe could reshape the entire 2026 vehicle landscape, because Ford appears to be preparing a move that targets the one segment no automaker ever wants to disturb, the one category that drives the biggest profits, the one area that, if shaken, could push the US market from meltdown into full-blown transformation. That segment is the full-size pickup arena, the crown jewel of American automotive profit, and the battlefield where Ford is preparing a disruption so aggressive that insiders are calling it the next F-150 moment. The rumors swirling through the industry point toward a strategically engineered hybrid platform that delivers V8-level torque with dramatically better fuel economy, all at a price point that undercuts competitors by thousands. If this launch happens on the timeline sources are whispering about, it could flatten the pricing structure of the entire truck market overnight. GM and Ram, both heavily dependent on their high-margin truck sales, are already bracing for impact because a price war in the pickup segment threatens not only their sales, but their entire financial forecast for the next 2 years. What makes this even more explosive is Ford's reported plan to flood the market with inventory the moment the new hybrid trucks roll out. Dealers have quietly confirmed future allocations that are higher than anything seen in the past 3 years, signaling Ford's intent to saturate the market before competitors can even respond. This is a power play unlike anything happening in the industry right now. Ford isn't just competing, it's trying to dominate through sheer volume, lower production costs, and aggressive pricing. If executed correctly, this could force GM and Ram into rushed incentives, trimmed profits, or even early refreshes that disrupt their carefully planned model cycles. In a market already under strain, that kind of shift could trigger a chain reaction of financial instability across multiple automakers. At the same time, Ford's strategy is aligning with a broader consumer shift happening in real time. With interest rates slowly easing and household budgets stretched from years of inflation, buyers are leaning hard toward vehicles that offer long-term savings without sacrificing power. Ford's renewed focus on efficient hybrid trucks and SUVs hits that sweet spot perfectly. This is why reservations and pre-interest lists for Ford's upcoming models are already filling faster than analysts expected. The market is speaking loudly, and Ford is the only company responding with immediate action rather than long-term promises. Every other automaker is still in presentation mode. Ford is in execution mode, and that difference is what's driving this meltdown. Even more quietly, Ford is positioning itself to reshape the service and maintenance landscape. New parts distribution hubs, expanded mobile service fleets, and upgraded diagnostic systems are being rolled out in major regions to reduce wait times and boost customer retention. While competitors wrestle with backlogs and shortage-driven delays, Ford is preparing to keep buyers locked into the ecosystem with faster repairs, smoother service experiences, and lower long-term ownership costs. It's a strategic move that doesn't make headlines but pays off massively in customer loyalty. And in a market meltdown, loyalty becomes one of the most valuable currencies a brand can control. But the most surprising turn of all is the chatter coming from Ford's internal tech teams. Whispers about an upcoming integration that merges driver assist tech, connected services, and real-time performance monitoring into a system that could outpace anything currently offered by competitors. If even half of those details are true, Ford might be setting the stage for a software leap that blindsides the rest of the industry, especially brands that have been slower to upgrade their digital ecosystems. And this brings us to the next critical moment, because the next phase of Ford's plan appears to involve a bold move that could send another shockwave through the already fragile US auto market. A move that industry watchers believe could completely redefine how Americans buy cars in 2026 and beyond. According to multiple insiders, Ford is preparing to test a semi-direct sales hybrid model, not fully abandoning dealerships, but trimming the layers between the buyer and the factory. This would allow customers to lock in factory pricing, secure build slots faster, and bypass a huge portion of the markups and delays that have frustrated buyers for years. If Ford pulls this off, it won't just shake the table. It will flip the entire retail model that the US auto industry has relied on for more than half a century. Dealership groups are already lobbying behind the scenes, calling emergency meetings, and warning that such a shift could fracture the traditional sales ecosystem. But Ford's momentum suggests that the company believes a streamlined purchase experience is not just inevitable, but necessary to win the next generation of buyers. Meanwhile, competitors are scrambling to interpret Ford's long-term game plan, because the company's rapid-fire decisions over the past months show a pattern of calculated disruption. First came the shock price cuts, then the aggressive production ramp-up, then the wave of new incentives, and now these whispers about retail transformation. Each individual move creates pressure, but combined, they create a market storm unlike anything the modern auto industry has seen. Analysts say Ford is playing a chess match where every piece moves faster than expected, and every move forces another brand into a defensive stance. GM, Hyundai, Toyota, and Volkswagen are all juggling their own challenges, from supply chain bottlenecks to factory overhauls, and Ford's timing, whether intentional or perfectly lucky, is hitting them at their most vulnerable moment. This rising instability is also impacting the auto loan and leasing markets. Financial institutions are reshuffling rates, adjusting risk models, and recalculating residual values because Ford's aggressive price strategy is pulling used car prices downward. Banks rely on stable depreciation curves to predict the future value of leased vehicles, but Ford's sudden market pressure is now rewriting those curves in real time. This is causing ripple effects across credit unions, lenders, and lease providers, all trying to figure out how to price vehicles that may lose value faster due to Ford's disruption, or in some cases, may hold value better if Ford manages to dominate the hybrid and truck segments. This uncertainty is fueling the narrative that the US auto market is not just unstable. It's on the edge of a complete recalibration. And surprisingly, consumers seem to be adapting faster than the industry itself. People who were once hesitant about EVs are now reassessing them because Ford's lower lease rates and expanded charging partnerships make electric ownership less intimidating. Drivers who swore off hybrid tech are now lining up for it because of Ford's upgraded powertrains and improved towing stats. And longtime truck loyalists, the backbone of the American auto world, are watching Ford closely as hints of new hybrid trucks and lower entry prices surface. The shift in consumer psychology is happening fast, and Ford is steering it with almost theatrical precision. But the next development brewing behind the scenes might be the most disruptive of all, and it has nothing to do with pricing, production, or incentives. It's tied to an upcoming reveal that could attack one of the industry's most protected profit centers, a reveal that insiders say could dismantle one of the biggest profit engines in the entire auto world: service and maintenance revenue. According to internal leaks, Ford is preparing to introduce a new generation of vehicles built around significantly reduced lifetime maintenance requirements. Not just longer service intervals, but redesigned components meant to last dramatically longer without costly replacements. If this holds true, it could devastate dealership service departments, which rely on maintenance work for a massive portion of their income. More durable hybrid components, simplified drivetrain layouts, easier to replace electronics, and extended warranty structures could pull billions of dollars out of the traditional service ecosystem. For customers, it's a dream. For competing automakers, it's a nightmare. And for the US auto market already reeling from price cuts, inventory shifts, and collapsing margins, this would be another shockwave in a year, already overflowing with chaos. Dealerships are buzzing behind the scenes, trying to figure out how to survive a future where customers walk in less often, pay less for repairs, and rely more on software updates than physical maintenance. Some stores are preparing to pivot toward accessories, aftermarket customizations, and subscription add-ons just to offset what's coming. Others fear they simply won't be able to keep up if Ford's plan expands nationwide. This potential disruption aligns perfectly with Ford's long-term goal of cutting ownership costs and boosting loyalty. If a Ford stays cheaper to maintain for 8 to 10 years, then every repeat purchase becomes far more likely. And Ford's leadership knows that loyalty, not one-time sales, is what sustains a brand through market meltdowns. At the same time, Ford is tightening its technological grip on vehicle diagnostics. Their latest updates hint at a unified diagnostic ecosystem where real-time sensor data can predict failures, automate maintenance scheduling, and even initiate parts shipments before a breakdown occurs. This proactive maintenance approach would not only reduce repair expenses, but also eliminate the surprise costs that drive customers away from aging vehicles. Competitors who are still using fragmented diagnostic systems can't match this pace yet, leaving them vulnerable as Ford positions itself as the brand with the lowest long-term headache factor. And in a stressed economy, consumers gravitate toward brands that promise fewer problems and more predictability. In the corporate world, financial analysts are now warning that if Ford continues this acceleration, we could see the biggest reshuffling of automaker rankings in over a decade. Market share, stock price trajectories, and consumer loyalty indicators are all showing early signs of shifting in Ford's favor. What looked like a risky pivot a few months ago is now looking like a masterstroke that could reshuffle the hierarchy of American automakers. Meanwhile, tensions are rising inside competing companies as executives scramble to reevaluate their 2026 lineups, marketing strategies, and pricing models. Some brands are even considering cutting entire vehicle lines to conserve resources and refocus on core models that can withstand the pressure Ford is creating. But the real turning point, the one that could send the US auto market into a full-scale transformation, is tied to a development that Ford has managed to keep surprisingly quiet. A development that analysts believe could change not only what vehicles Americans buy, but how those vehicles are powered, produced, and integrated into everyday life. And that moment appears to be approaching faster than anyone expected, because Ford's next move is rumored to. And as the dust settles, one thing is clear. Ford isn't just reacting to the market, it's redefining it in real time. The US auto industry is shifting under our feet, and whether competitors adapt or collapse will determine the next decade of American mobility. What Ford is doing right now isn't a trend, it's a turning point, and we're witnessing history happen one announcement at a time. Stay tuned because this story is far from over, and the next wave of shocks is already on the horizon.